Time for Ask Annex. As always, if you've got a question for us, you head to our website, annexwealth.com, look for the Ask tab. In the studio, Matt Morzy, Investment Team Manager, also CFP. Hey.
Hey, Danny.
And we got Fred Coleman, CFP, Wealth Manager. Welcome back.
Thank you, Danny.
First question on Ask Annex. There are so many indices. What do you guys follow? And she put that many O's on so. There's so many indices. What do you guys follow?
There are a lot. You can make an index for pretty much anything that you want to track. You know, from an internal standpoint, what we like to look at is going to be specific to the goal or the breakdown of what we're trying to accomplish. And then, you know, indices give you kind of that framework. And then obviously as active managers, we want to beat that indice then as well too. So you want to really know what you're mapped up against. From a client perspective, a lot of times they focus on whatever they hear in the news, which a lot of times is the S&P 500. When tech is doing
Isn't it most of the time it's the Dow, though?
The Dow's kind of the weird one. That's the longest one that's been out there, but it's only 30 companies, and it's got a really weird mix to it. And that's really important when you look at indices. How do they create it, and how are they tracking it? So the Dow is a price-weighted index, which means that they've got their 30 stocks, and they're ranked by the price per share. So the highest price per share has the highest weight. The lowest price per share has the lowest weight. So Apple, which is there, is not even a top 10 company in the Dow, but it's the largest company in the world. So for the S&P, it's the largest weighting there. So very, very different there. Really, when we're looking at things, we want to try to broaden that out. So we like the MSCI, ACWI, IMI. And what that stands for, the ACWI is the All Country World Index. IMI is the Investable Market Index. And it's basically 99% of the world's equities fit into that index. So very, very broad. Gives you a lot of room, but you want to make sure you're covering everything when you're looking at that. So that's why we look there.
Next on Ask Annex, and it's a long one, recently discussed consolidating my 401k into my IRA with my blank broker, and was told the funds I hold are proprietary to my former employer and cannot be moved. Suggestion was to speak to the 401k administrator and have them simply liquidate holdings and hold cash in the account, then roll it over. Since nothing is paid out to me directly, this supposedly won't trigger any tax concerns. Does this sound right?
Yes, you have to be very cautious when you're making these types of transactions. I recommend having a professional assist you with the rollover. Our client service managers here do an excellent job of getting on the phone with you to ensure that the rollovers are done correctly. If you are doing it yourself, most of the time you are going to have to liquidate the funds, but the key is to make sure that the check is made out to the custodian. Even better, if the 401k company can wire the funds directly to the custodians, the funds should never touch your bank account. If it's coded as a direct rollover, then you won't have any tax implications. And also, if you haven't went through that rollover process yet, feel free to reach out to us and we can help you out.
Number 3 on Ask Annex, my mother-in-law is very risk averse. She found a list of 6 low-risk investments. One of them is preferred stocks. Is that a low-risk investment?
I think there's 2 different parts to this question. So first, preferred stocks, kind of what are they? So when you look at a capital structure of a company, they're generally going to be using stocks, or what we would call common stocks, or bonds. But in the middle ground, there's this weird area of preferred stocks. It kind of fits in the middle of the 2 when it comes to a risk standpoint. So let's say a company is going through bad times and has to go through bankruptcy. If they're not being sold to somebody else, what they'll have to do is sell all of their assets and start to pay out people. First is going to be bonds. That's the creditors, the people that they owe money to. If there's still money left over, then they do preferred stocks. Lastly, common stockholders, and most of the time, if that's the situation, common stockholders kind of don't get paid out, and that's the risk for having those stocks. So when you're looking at a capital structure, it fits right in between those 2 things. The second part of the question, that you found a list of 6 low-risk investments, that is really, really subjective, and it's subjective to the person, but also the portfolio. When we look at investing in anything, whether it's a bond or a stock, you want to look at not only the benefits of owning that investment, but you also want to look at it in the context of your overall portfolio. There's times that you could have something that could be very high risk, lots of volatility, but if you add it to our portfolio, you might actually lower the risk of the portfolio. That's the benefit of diversification.
I agree with Matt. I think it really depends on your definition of what risk is. They still are riskier than bonds, but not as quite as risky as a common stock. They do usually also carry a higher coupon, and they don't have any term. Those coupon payments can go on essentially forever unless they're called. Sometimes you do have the ability to convert them to common stock as well.
Final question on Ask Annex. I'm holding funds in cash, but keep hearing I might miss the boat on transitioning to bonds. Until rates are cut, why am I not fine where I'm at?
I'm going to assume that cash in this situation is in a high yield savings account, something that you're getting a higher interest rate at. And for that reason, you're hesitant to move out of something and take risk because you are getting paid to be in that high yield savings account right now. If you're just in a straight checking account and you're not getting any interest, well, you might want to at least look at that high yield savings account. But from a standpoint of getting 4 or 5% in your savings versus going to bonds, the reason why that you don't want to wait until yields come down is because bond prices will go up along that way. They work inversely of each other. So yields come down, prices go up. And if you wait till all of that's happened already, you've lost out the price appreciation of the bond and you're getting the lower yielded bond later on.
Matt Morzy, Investment Team Manager and a CFP. Thanks.
Thank you.
Fred Coleman, CFP and a Wealth Manager. Thank you.
Thanks, Danny.